Hello, everyone. So we meet today to discuss the budget which has been proposed by our finance minister. And from SKJ, Nishant and me would be trying to share with you our thoughts on what has been done in this budget. We are going to be mainly dealing with the direct tax and the indirect tax issues. Uh, of course, we don't think we are qualified to talk about the overall budget policy which has been proposed. But yes, we are better qualified in trying to understand what has been proposed for the direct and the indirect tax uh, provisions that have been brought in. It has been seen over a period of time that there is not much that the finance minister can really do as far as changing the tax rates or getting better deductions made available to the assessee. Uh, that's not the case anymore since the last so many budgets we've been seeing that. Uh, though it is many a times portrayed that there have been so many tax friendly in the sense where your tax would reduce, those kind of policies have been brought in. When you really look at the numbers, that's not the case. But does that mean that that makes the budget good or bad? No, I don't think so. Uh, what we've been seeing is that in the proposals that are brought in, more and more changes are from the perspective of whatever small window that has remained to be plugged. Those are being plugged. Some redundant sections are being removed. Some administrative convenience is being brought in. That's what is there nowadays in the direct tax and the indirect tax budgets. So if we think that we are going to be seeing some, huge tax changes, the answer is no. But today it is important for all of us to understand the budget because all of us who are doing businesses, there is a lot to be taken care of. We have made a small PowerPoint presentation which will guide us through the whole process. We've tried and divided the whole budget into different sections, which will be in litigation, what has come in salaries, what has come in, and things like that, so that it is easy for all of us to follow and understand the proposed changes. Without taking more time, let's directly jump into the issues that have been proposed. So we will first start with the personal taxation amendments that have been brought in. The change that has been harped on when the budget was being presented is how the new regime, certain changes have been done which are going to be more tax friendly, and how the tax rates is going to look at. So the proposed amendments in are all pertaining to new regime. So if anyone is thinking that they would be, anything is available if they continue to opt for the old regime, there is absolutely no change in the old regime. The tax rate changes are concerning only to the new regime. One important aspect is the new regime was earlier available only to individuals and HUFs. Now it is also available to AOPs, BOIs, and artificial juridical persons. The basic exemption limit has been increased from 2.5 lakh to 3 lakh. And on the screen, you would be seeing the new slab rates. So up to 3 lakh nil, 3 lakh 1 to 6 lakh 5%, 6 lakh to 9 lakh 10%, 9 to 12 15%, 12 to 15 20%, and above 30% is the tax rate that we are looking at. The maximum surcharge has been reduced from 37 to 25% only for the new regime. The existing limit of rebate has been increased. So the income which was not taxable up to 5 lakh has gone up to 7 lakh now. So the rebate limit from 12,500 has been increased to 25,000. Which means we'll come to the tax calculation later. So don't be under the belief that your tax, you are not supposed to pay tax up to 7 lakh in case your income exceeds 7 lakh. So only if you are below 7 lakh, this rebate is available to you. Standard deduction up to 50,000 is available now. And there is a family pension of 15,000, which is allowed to salaried individuals in the new regime. Another important aspect, till last year, we had to choose which regime we had to go in. If you wanted to shift from the old regime to new regime, you had to choose the new regime. They have reversed the process. Now, in case you want to continue in the old regime, or you want to opt for the old regime, you will have to opt for that. New regime is the default regime. For opting into the old regime, there is a prescribed form which you will have to upload. The surcharge changes up to 50 lakh nil, 50 lakh to 1 crore 10%, 1 to 2 crore 15%, and above 2 crore 25%. As far as the slab rates, no changes in old regime. So a comparative of the slab rates is also given over here to just give you an idea of how taxes are going to be computed. So up to, the old regime tax rates continue as it is. We'll come to the comparative taxability in, just a bit. So we've tried to make a few slides to show that assuming there are no deductions, then how does the old regime and the new regime look like? What are the tax savings in it? In case there is a deduction which you're claiming under Chapter 6A, which is you have PPF or Mediclaim and things like that, then in comparison to that, if I take those deductions versus I don't take any deductions and I go into the new regime, then how does it look like? Then we've made one more comparison where you have Chapter 6A deduction, which is Mediclaim, PPF, etc. Plus you have a deduction under the head house property. Then how does the comparison look like? So the first slide, where there is an assumption that there is no deduction, just to draw your attention, we've also added one more column which is highlighted, which shows income to be 7 lakh 10 rupees. So up to 7 lakh, as per the new regime, no tax. But as soon as in the new regime also, your income becomes 7 lakh 10 rupees, you have to pay a tax of 26,001. So in effect, if a person is earning 7 lakh and somebody who's earning just 10 rupees more than him, in reality, his take home is at least 26,000 rupees lesser. Normally, for such kind of anomalies, for example, in surcharge, the Act used to provide that they will give a bridge where a person who's earning more does not have to pay more taxes and become less earner than the person below him. But this anomaly was there even when the new regime was introduced last year and there was a 5 lakh limit. That anomaly continues even in this year, and there is a 26,000 rupees difference. And then, of course, we've made a comparison. So where there are no deductions, the new regime is better as compared to the old one for taxpayers to opt for. Then the next slide, meaning this slide, shows if you have standard deduction and deduction under Chapter 6A, then up to 7 lakh 50,000, there is the old regime seems to be better. There is a difference of 8,319. Sorry, new regime itself, but because of that 10 rupees difference, there is a difference over here. But again, here also, new regime is more effective than the old regime, only except when you are earning just 10 rupees more than that rebate provision. And then next is the comparison where you have a deduction under Chapter 6A. Even over here, the new regime is better than the old regime. But as soon as you take that additional deduction of 2 lakh rupees, then up to rupees 5 crore of income, the old regime of taxation is better. If you see up to 15 lakh, from 15 up to just before 15 lakh, the old regime has more savings. And after 15 lakh, both are paying the same taxes. Only when your income exceeds 10 crores, because there is an additional surcharge, then the new, whether you are in old or whether you are in new, it makes no difference. There has been a change in the presumptive taxation. So earlier, up to 2 crores, you could go for presumptive taxation, and professionals up to 50 lakhs could go for presumptive taxation. That has been increased to 3 crores and 75 lakh. The exception being that there should not be any cash receipts which exceed 5%. So people who have cash receipts which are less than 5%, but their annual turnover in business is less than 3 crore, can go for presumptive taxation. And for professionals whose annual receipts are less than 75 lakh, can go for presumptive taxation, provided their cash receipts is less than 5%. There is a change in deduction which is being claimed under Section 54. So earlier, whenever a person was selling an asset or a residential house, he was eligible for deduction under Section 54 and 54F. While this deduction basically is when you're selling an asset or you're selling a house and you buy a new house, then the gains, in case of 54F, the entire consideration had to be reinvested. In case of 54, the capital gains had to be reinvested. But once you did that, then the gains that you were earning were tax free. There was no limit for the cost of the new house. But now there is an amendment which has been proposed from next year onwards, that is for assessment year 24-25. If you have a capital gains and you buy a house, the value of which is more than rupees 10 crore, then your deduction will be limited to rupees 10 crore. Now, there was a very interesting question that came up in our discussion. Say, for example, somebody had capital gains in the earlier years and they deposited that amount in the capital gain scheme account. The capital gain scheme account allows you to utilize that money for purchase of a new property within 2 years or construction of a new property within 3 years. So I had my capital gains in earlier year and I proposed to buy a new house in assessment year 24-25. Then whether this limit of 10 crore is applicable or not. So when we see this amendment has been brought in subsection 1 of section 54, not in subsection 2, which means that it is at the point of capital gains that the limit is going to become applicable. So people who have had capital gains prior to assessment year 24-25, they do not have to worry about the new limit of 10 crores if they have opted to put the money in capital gain scheme account. People who are going to earn gains in assessment year 24-25 and onwards, only to them this limit of 10 crores is applicable. Now, interestingly, there was a window available, a tax plan that was available, a exemption, a deduction that was available for computing capital gains till now. And obviously the finance ministry thought that this is a loophole which needs to be corrected, and they've brought in an amendment. So this all started from Mumbai when the Mumbai cooperative housing societies underwent redevelopment process. So when they underwent redevelopment process, there was a lot of FSI which became available because of change in corporation laws. When this FSI came to them, obviously there was no credit, there was no cost for this additional FSI which suddenly fell into their lap. So there was a celebrated judgment of Srinivas Sethi, Supreme Court, which said that whenever there is no cost, then the mathematical formula fails, because anything minus infinity is infinity. So you cannot compute gains. Because you cannot compute gains, whatever that you earn from sale of this FSI is not taxable. So there were many tax plans around this. So people started selling FSI, people started giving their FSI to others, and many people took a stand that this is not taxable. And obviously the courts upheld all such decisions and said that this is not a taxable item. Then came a change. This was also being used for tenancy rights and goodwill earlier, where they said, people are squatting in flats or land, and they said that we've not incurred any cost for buying the rights in those land. But when they were given money to move away from there, that amount was treated as tax free. Then an amendment came that the cost of such right would be taken as zero. So now the formula does not fail. You can compute capital gains and it started becoming taxable. That same formula has now been brought in for all intangible assets or assets where there has been no cost of acquisition. So now the amendment is that wherever there is no cost of acquisition, the cost of acquisition will be treated as nil, which means your capital gain formula will work and you will have to pay capital gains tax. So all the people who are selling this FSI which came to them and they were not paying taxes, all that will become taxable from now on. Now, this is for investors. All the investors who had invested in this market-linked debentures, whenever the market-linked debentures were held for more than 3 years, it was treated as long-term capital asset. And when this market-linked debentures was sold, long-term capital gains were being claimed and exemptions related to long-term capital gains were being claimed. What was seen that these market-linked debentures, actually the underlying asset for them is debt. So these market-linked debentures are actually investing in underlying assets which are in the form of debt security. So in effect, you are earning interest. Interest is being earned, but since you have held the debentures for more than 3 years, you're claiming long-term capital gains. So the finance ministry has thought that this is not right, because the underlying asset is in the form of debt. It should be taxed at full rate. So this is going to be treated as short-term capital gains. As soon as it becomes short-term capital gains, it is taxed as normal income. So here's the illustration. Full value of consideration is X, less cost of acquisition, less expenses linked to transfer. Capital gain, forget the period of holding, is always going to be treated as short term. Then rationalization of exempt income under life insurance policies. Obviously, all this is for the rich and the upper middle class and those kind of people. What they have said is that if your premiums are exceeding 5 lakh rupees in a year from a single policy, then the money that you receive from these insurance policies will be treated as income from other sources and will be taxable. This is also applicable from assessment year 24-25 and for all policies which are issued after 1st April 23. That is why you must have seen that a lot of insurance stocks have also taken a beating in the stock market. Uh, these are all for policies taken after 1/4/23, with the exception that in case of a death of a person who's insured, the money that is received will still be treated as exempt. Prevention of double deduction claimed on interest on borrowed capital for acquiring, renewing, or reconstructing a property. Now, what had happened was uh, when I'm buying a property, I had this 2 lakh rupees interest, which was allowed as deduction if I'm in the old regime. Apart from that, the interest that I was paying, the argument was that I am paying this interest because my income is being worked out under income from house property. This deduction should be allowed. But at the same time, when I sell this property later, since my cost of acquisition is computed under another head, whatever interest that I have paid should be allowed as cost. And therefore, a double deduction was available to an assessee, one by way of interest, the other by way of improvement of property by way of payment of interest. So that was capitalized and cost was taken. This has been plugged. They say that if you have taken the interest deduction, cost will not be allowed. This change is basically one of the judgments. There are many judgments, but one of the judgments is this Chennai tribunal, which had held that this double deduction is allowed. To reverse that, this amendment has come. Tax on winnings of online games. So, when we see the provision earlier, also winnings from lotteries and games and all other things were taxable. And people were supposed to withhold TDS at 30%. And the winnings were also taxable. So there was one thought that why did this provision at all come in? Because there was no escapement in this. In any case, it was taxable. So what was the need? The thing is, this provision says that if you are doing online gaming, normally for online gaming, you have an account from where you play the game. This account, whenever you exit that account, at the time of closing of the account, either you are to pay money or you are supposed to receive money. The earlier provision, what it did was every time that you earned money, there was an interpretation that accrual of income or payment of income, whichever was earlier, you are supposed to do TDS. But till the time you are logged into the account, there was no payment received or payment that was to be done. So that was causing a lot of inconvenience, hardship for all these online gaming companies. So they came up with a solution. They said for online gaming, whatever is the balance in your account at the time of exit from your account or 31st March, whichever is earlier, whatever is the net gain that you have, because you could have lost money also, you could have earned money also. Whatever is your net gain on that 30% TDS is to be done. And then the money is to be given or the account has to be carried forward. So this, really speaking, has brought in more convenience rather than inconvenience. This was a very interesting provision that was brought in. Before we discuss this provision, which is conversion of gold to electronic gold receipts and vice versa, I'll just give you a few, I'll just rewind to a few events in the history. All of us remember that before bringing in the Black Money Act, the government announced that people who own foreign assets, please come out, declare your assets. We are going to give you one-time immunity. You have to pay some taxes. You have to pay some penalty. Declare those assets, pay those taxes, and be happy. We will not prosecute. We will not initiate anything against you all. Some people did take the opportunity. Many people did not take the opportunity. Once that scheme was over, Black Money Act was introduced with some draconian provisions where above a certain amount, you could be straight away put behind bars. Similarly, then came one more scheme of the government, which was voluntary disclosure scheme. They said you disclose your money, whatever is your undisclosed money, pay taxes at a higher rate, 45%. If you do that, you're scot free. If you don't do that, bad luck. If you catch you, there will be taxes. Immediately after that, for undisclosed income, they increased the rate of tax to 60%. And also they brought in the demonetization provisions. So people who had money which was not declared, the intention of the demonetization was that they should not be able to use that money. So the government has given opportunities before bringing in stringent laws. Now, gold is a very, an asset which the smallest of households in India owns. They've come up with a scheme where they say that if you convert your gold into a gold receipt, electronic gold receipt, it will not be treated as transfer. And you can hold gold in an electronic form. Similarly, you can reconvert that back into gold and there will be no tax on this. It will be an easy transfer from one mode to the other. This will not be treated as transfer. If I have to think about the history, then my feeling is that this is the first step. After this, there could be a time when the government says that apart from jewelry, if anyone is found with gold bars are banned. You can't own gold bars. You can have gold bars only in electronic form. And if that happens, all the people who are holding golds by way of bars, which are not declared, again, there will be a rush, just as we saw when demonetization was announced. I'm not saying this will happen, but looking at what the government has been doing from time to time, first giving an opportunity for all of us to come clean. Again, something new has been announced, which prima facie has no tax implication, but has been brought in. Obviously, there has to be some reason for doing this. One reason could be to improve the gold reserves, but I don't know what are the other reasons also which go along with this. Then we come to the next set of amendments, which is corporate taxation amendments. So there is a amendment which has been brought in for payments to be made to MSME. What happens is people who are registered under the MSME Act has provided that in case that there is no written contract, then the payment due to an MSME is 15 days. In case there is a written contract and the written contract says payment in 90 days, even then MSME says that you have to pay the MSME in 45 days. So what was happening is all these MSMEs, to support MSME and see that they receive their payments in time, the government has brought in this amendment where they have said that people who are dealing with MSMEs and they are booking their bills. After booking their bills, they are not making their payments in time. Then the expenses claimed will not be allowed as deduction. Subject to the fact that if you have made the payment before filing of the returns, sorry, before 31st March, only those are allowed, or within those 15 days or 45 days after 31st of March, provided they are in the due date, only those are allowed as deduction. Otherwise, they will be carried forward and allowed as expenses in the year of payment. So, when I was having a discussion internally, we were saying that as far as professionals are concerned, whether it is a chartered accountant or whether it is a lawyer or whether it is an architect, normally they don't raise an invoice till the time they are sure that they will get the payment, because otherwise they have to pay GST, which is a payment from their own pocket. So probably for them, this may not make a big difference. But all the other small enterprises, manufacturing enterprises, trading enterprises who are registered under MSME and whose bills the other enterprises have to book, they will have to make the payment in time, otherwise face huge disallowances. And to deal with this section, so what are the challenges that we face over here? Now, the burden of compliance on the person who's booking expenses has increased tremendously. First of all, he will have to take a declaration from the supplier of services or supplier of goods that whether you are registered under MSME or you're not registered under MSME. Because unless and until you have that documentation with you, how does the auditor check while making the audit report of the compliance done for this provision? Now, once you get this declaration, then you will have to keep track that you've made the payment in time. If you've not made the payment in time, again, that will have to be flagged somewhere in the system, because that also has to be reported by the auditor in his tax audit report. So will the amendments actually help MSMEs? Yes. People who are in the trading fraternity, manufacturing fraternity, it will help them. People who are providing professional services, I think that it may not be of a very great help to them. Another important aspect which we need to keep in mind is wherever provisions are being made in the books at the end of the year. Say, for example, you make audit provision and the auditor is registered under the MSME Act. The MSME Act says whether oral agreement or written agreement. So as soon as you are making provision, you're also doing TDS. You are identifying the person who the payment is to be made, which means you should have made the payment within 15 days from making that provision. Now, these provisions are made normally at the end of the audit period, which means as soon as you make this provision, this is going to be disallowed. It is going to be added back in your income. And it is going to be allowed as expenditure only in the year of payment. So all the I'm talking only about tax auditor's remuneration. There could be so many other provisions that you are making of the bills at the last minute. And if all those people are under the MSME, then there is a high chance of all these being disallowed. Another thing that I would just want to announce is that I'm sure quite a few of you all may have some questions or clarifications that you need while we are going through this presentation. I request you to hold on to your queries, write it down somewhere, and we will definitely deal with them at the end of the session. The next provision is concessional rate for rate to new manufacturing cooperative societies. I don't know for how many people this may be relevant, but there is a proposal now, just as a private limited company has been given special tax rate if they start with manufacturing. A cooperative society is also given the same benefit of 15%, but they have to start their production before 31st March 24. So practical challenges to set up any unit within 1 year and start production. We see that challenging in many places. So I don't know how many cooperative societies will be able to take this benefit, But yes, this benefit has been given out to cooperative societies also. There was an interesting issue on benefits and perquisites which were being doled out in cash. So the whole controversy was there is a section 28(4) which was brought in last year. What it said is that people who are getting perquisites in kind, they are supposed to pay taxes for the perquisites that they have received, the benefits that they have received. For example, if as a chartered accountant, or if as a doctor, or if as a businessman, I've received gifts from people, those gifts are perquisites which I have received while doing my profession or my business, and those have become taxable. Now, the stand that was being taken was that this is only for gift in kind. This is not for money. Now, when did this money come in? Because money was otherwise taxable under Section 56 for gifts. So people who were taking waiver of loan, say I took a loan from the bank and then I could not repay it. I became an NPA. I did a one-time settlement with bank and my principal amount was waived off. So when the principal amount was waived off, there were two things that happened. The assessing officer said that I will tax this either under Section 41(1), which is when you write back any creditors in your books, trade creditors in your books. And the other is, if not 41(1), I will tax you under 28(4), which is perquisites. This you've received it as a perquisite and I'm going to tax it in your hands in that manner. So at that time, there was a decision of Mahindra and Mahindra which came up and said that when a loan is written back, which is capital in nature, it will not fall under 41(1). And since 28(4) deals only with perquisite in kind, it is not even taxable under 28(4). So to plug that loophole, so when there is a waiver of loan which is capital in nature, now under 28(4) it will become taxable. So this is to plug the Mahindra and Mahindra judgment. Then comes Section 269ST and 269T. So for primary cooperatives, now these primary cooperatives are generally running only in the rural areas, and they are dealing directly with farmers and artisans and at the ground level, at the grassroots level. So there also there was a limit of 20,000 for the money that they were exchanging. That has now been increased from 20,000 to 2 lakh because this was causing a lot of inconvenience at the ground level. There is a relief which has been now given for startups and setting off of losses. So earlier the carry forward and set off of losses was available for 7 years. That has been increased to 10 years for startups, and that 51% shareholding, etc., has continued, which was there even in the earlier years. So even if your shareholding changes beyond 51%, earlier the law was for other companies, the law is that if your holding changes for more than 51%, then you're not allowed carry forward or carry forward losses to be set off in the future. This was exempted for startups, so that continues to be so. Plus, they have increased the number of years from 7 years to 10 years. Eligible startup, the time limit has been increased. Earlier it was the 1st April 23. Now they have extended it to 1st April 24. So you could register your startup up to 1st April 24. Earlier, whenever preliminary expenses had to be claimed, there was either you had to go to a person, a concern who was approved by the board and incur those expenses through that approved concern, only then 35D was allowed, or you had to incur it on your own. Now they have amended. They have said that you don't have to go to any approved unit. You furnish a statement containing the expenditure, and then you give it to the body authorized by the board, and they will approve it. Tax return to be filed in time for claiming exemption under section 10AA. So 10AA, there was no condition of 139 months. So all other provisions, what they have said is that if you are claiming any deduction or exemption, you have to file your return in time. Only if you file it in time, will you be allowed to claim the exemption. So that has now been extended to even 10AA, which are the SEZ units. Also, there is another amendment which has been brought in. So when we say that there has been export of services or export of anything, the export was determined, the value of export was determined on the basis of the foreign exchange that has been brought into India. So earlier, we had to comply with the RBI rules, where if, say, for example, I'm not getting my money within 6 months, then I had to apply to the RBI and ask for extension. If the RBI extended it, even if I got my export proceeds after beyond 6 months, that was allowed as export money that has been received. That was included in the export turnover for claiming the deduction. Now they have done away with taking approval from RBI. Now you have to take approval from the authorized person by the board. Tax avoidance through distribution of, by business trust to its unit holders. So earlier, whatever interest, dividend and rental was being given by REITs and InvITs to the unit holders, there was a pass-through entity, there was a pass-through status. It was taxed directly in the hands of the unit holders and not in the hands of the REIT or the InvIT. So what these REITs and InvITs were also doing is, apart from giving money by way of dividend or rent or interest, they were also partially distributing the money by way of redemption of the capital amount. So they said that, for example, if I have to give 100 rupees to the unit holder, 70 rupees was given by way of dividend, interest, rent, and 30 rupees was claimed to be given out of the investment made in the unit. So that was treated as non-taxable. So it was a good way that they had found out to postpone the tax liability. They said that whenever we redeem the units in the end, we will say no value is remaining. Whatever that we are giving now should be taxed now, being the difference between the value of redemption minus the cost that remains. So now what the government has done is they said that whatever that even if you claim that you have given something out of the principal amount, that will be taxable in the hands of the recipient. And unless and until you say that there is a redemption process which has started. So if there is a redemption process, then whatever money is received minus the cost of redemption, the balance will be taxable in the hands of the unit holder, or the entire income. If there is no redemption, then the entire amount, even though it is nomenclated as money which is given against the principal amount, it will be taxed in the hands of the recipient. Amendments related to non-residents. So there was again one small loophole. What was happening is that if I gave gifts to people resident in India or people who are non-residents, who are not my relatives, then it was taxable in the hands of the recipient. They brought in this amendment for non-residents, saying that non-residents, even if they are not living in India, but if they are not relatives of the persons who was giving the gift, then it'll be deemed as if they have earned that income in India and they're supposed to pay tax in India for the amount that they've received. But when they got that amendment, they had not included resident but not ordinary resident. So there were many people who are giving gifts to resident but not ordinary resident, who are not relatives, and still the recipient was not taxable. So this was one loophole which was there. They have plugged it now. The other thing that they've done with non-residents is that whenever a non-resident is buying shares in an Indian company and the value that is derived from issuing the shares to the non-resident. For example, if I buy a share in a company today, which is not listed, as per valuation, the value of the shares is 100 rupees, but I buy it for 160 or 150. The recipient company is supposed to pay tax on the excess amount received because it is beyond valuation and it is treated as gift in the hand of the recipient. This was not applicable when the money came from non-residents. Now this has also been changed. If you receive any money from non-resident in excess of the valuation which has been determined, then that excess value will be treated as gift in the hands of the recipient company, and the recipient company will have to pay taxes. Next is withholding tax. So a cooperative society which was withdrawing cash, there was a TDS provision. So we've given a chart of the existing provision and the new provision. If you see a cooperative society who's filed ITR and a cooperative society who has not filed ITR, if they are withdrawing cash up to rupees 3 crore and they are filing ITR, there is no TDS. But above rupees 3 crores, there is a TDS of 2%. Earlier, this limit was 1 crore. Similarly, cooperative societies who are not filing ITRs and withdrawing cash of up to rupees 20 lakh to 3 crores, the TDS is 2%, and above 3 crores, it is 5%. Earlier, this limit was 2 lakh, 20 lakh to 1 crore was 2% and above 1 crore was 5%. Now, there are quite a few housing societies whose expenditure is more than 20 lakh. And quite a few of them withdraw cash and do the expenses. All this should be avoided because if you're withdrawing cash of more than 20 lakh and if you're not filing returns, then you will be in trouble. There'll be a TDS of 2%. Removal of exemption of TDS on payment of interest on listed debentures to a resident. So earlier, this is again plugging of a loophole. Wherever there was a payment of interest on listed debenture which was being made to a resident, there was no TDS. So what they have seen from the new technology that has been adopted where a lot of data is coming to them, they are seeing that these people who are receiving interest on debentures are not offering this for tax. So to track all these interest recipients, they have now incorporated this TDS clause into the provisions. Insertion of new section 194BA, tax at source on winning from online games. So we discussed about the online games. So 30% is the TDS. This will be on the withdrawal, on the closing of the account and withdrawal of money at that time 30% or 31st March, whichever is earlier, TDS of 30% will have to be done. This is applicable from 1st July 23. Section 206 AB, relief from special provisions for higher rate of TCS for non-filers of income tax returns. Now, this particular provision is for This is for TCS 50,000. This is 206 AB and 206 CCA. This is not really applicable for general public. This is for people who are in gift city and all. For them, there is this provision which has been brought in and nothing to do with your regular people who are filing their returns and residents. So relief from special provisions for higher rate of TDS, TCS for non-filers of income tax returns. This is for that gift city people who are not supposed to file returns and they are only exempted. Otherwise, for all other people. So this was one area where people were expecting some kind of a relief. There are, these foreign companies who have not taken PANs in India because they are not supposed to file returns in India. When they are not supposed to file their returns in India, there is a provision which says that if you are getting certain amount of income, then and you're not filing your returns in India, or if you don't have your PAN in India, then there will be double TDS. Now, this double TDS was causing a lot of hardship. So there were a lot of representations that went in. So there was an expectation that for people who are not having PAN in India and who are not supposed to file returns in India, for them, this double TDS should not be made applicable. The provision has been brought in, but it is restricted to only certain category of people. One is category 3 of AIF, and the other is people who are in the gift city. Only for these two, this provision of double TDS is not applicable, but for everyone else, this still exists. So the problem which was there continues to be there. Then increase in rate of TCS of certain. This is another important change that has been brought in. So people who are going overseas, there was a TCS which was brought in of 5% in the earlier years. All other cases also where the amount which was being remitted was more than 7 lakh, there was a TCS of 5%. For overseas package without any threshold, there was a TCS of 5%. This has been changed now. Overseas and any other case, they have said TCS of 20% will be applicable. And in case of education, for amount which is being remitted for more than 7 lakh, education and medical treatment, there will be a TCS of 5%. Now, when we say for education, it is 5%, there are some practical issues that we were discussing that have come in. Now, people have kids who are studying abroad, or there is a medical emergency which has happened abroad. So it's not that you will make the payment directly to the hospital or to the education institute. Now, if you're not making the payment to the hospital or to the education institute, then whether I fall in any other case or whether I will fall in the first part, which is payment towards education or medical treatment, and I should be doing 5% only if it exceeds 7 lakh. This question has arisen because the payment is not being made to education institute directly or to the hospital directly. So we thought we'll speak to, all these bankers who are the agents for remitting these funds. So when you're remitting the fund, really speaking, you have to fill up a form, you have to give a declaration. In the declaration, you have to mention for what the fund is being remitted. If over there you say that the fund is being remitted for educational purposes or for medical treatment purposes, then to which account it is going may not be relevant. You will still be able to withhold only 5%, but you will have to prove at the appropriate time that this money which has been transferred under the head of medical treatment or under the head of education has actually been utilized for that purpose. So you may have to keep the bills, you may have to keep the tuition fee receipts, etc. to prove that this money was utilized for that purpose, and then you will fall under 5%. Extending the scope of deduction of tax at source to lower or nil rate. So this is again a amendment which has been brought to get administrative convenience. There were certain receipts for which lower deduction of tax certificate could not have been applied for. So they've increased that scope. They've included a few more things in that. And for those incomes also, now you can apply for a lower deduction tax certificate. Alignment with provisions of 45(5)(a) and 194 IC. So this was another interesting issue that was being argued by many assessees and tax consultants. So there was a provision which was brought in a couple of years ago, which said that if you have a capital asset in the form of land or building, and you are doing a specified agreement means a joint development agreement or something of the sort, which is not a sale deed. And that specified agreement says that you're going to get certain consideration in kind, which is by way of area, and certain consideration in check or money. Then your capital gains is postponed to the year of completion of the project. For these purposes, people who are receiving cash in this transaction, a check in this transaction, said that the provision says that a person who receives cash or property, that will be considered for computation of tax. So the amount of check that I receive is not taxable at all, was the argument that was being taken. So to plug that loophole, they've said whether cash, check or any other mode, it will be taxable. TDS on payment of accumulated balance due to an employee. So again, this was earlier done at the maximum marginal rate for people who did not have PAN. Now that has been plugged and they have said that 20% for non-PAN cases is supposed to be done as TDS. So this provision was always there, but it was for maximum marginal rate. They've just brought in, instead of maximum marginal rate, now it is 20%. Tax treaty relief at the time for TDS under section 196A of the Act. So people who have tax treaties, the TDS which is to be done is the lower of the rate provided in the treaty or 20%, whichever is less. That's the only proposed amendment. Otherwise, this section was always there. 271C amendments in consequence of new provisions of TDS. So there were certain TDS provisions which were not covered for prosecution, for penalties, etc. They have brought all those provisions in this proposed amendment. So now everything under TDS will be covered for prosecution and for penalties. There are some amendments which relate to the litigation provisions. So the reassessment provisions 147, 148, 148A, 149. There was, when a person received a notice under section 148, there was no time limit which was given for filing of return. So what normally people used to do is, I've received a 148 notice. They've said you file your return under section 148. The person used to wait till the time limit for completion of assessment is nearing. Then he used to file the return, ask for reasons, and then the assessing officer did not have enough time to actually go through the return, ask questions, go through data, details, etc. So now they have said that within 3 months from the end of the month in which notice has been issued under section 148 or such further time as extended by the assessing officer, you have to file the return. If you don't file the return, then without issuing you further notices, they can continue to do your assessment. Similarly, what has happened is they have also made one amendment saying that if there is information received by the income tax officer, which is after 15th of March, then he had to issue the notice before 31st of March. So he did not have enough time to apply his mind to record reasons, to find out why the reassessment proceedings are to be undertaken, etc. And that was causing a lot of trouble and hardship to the department. So they have said that now whichever information is received after 15th of March, there will be an automatic extension of 15 days that will be available to the assessing officer for completing the entire process. They have also extended the time limit for completion of assessment. So a couple of years ago, they kept on reducing. Earlier, the time available for assessment was 2 years. Then they brought it down to 1 year. Then they brought it down to 9 months. Now they've realized that completing assessments within that compressed time period is quite difficult. So they have increased time limits for all the assessments at least by 3 months. So where it was 31st December now has become 31st March, where there was 9 months, now it has become 12 months, where it was 21 months, now it has become 24 months. And for cases where there is search, there is a substantial amount of extension that they have granted. For appeals, they have brought in earlier, long time ago, Joint Commissioner appeals was there. Then they had abolished that post. Now, in the last 2-3 years, because of the upgradation of system that they were undertaking, lot of appeals have not been taken up at all. Many people have filed appeals, their cases have not come up for hearing. And now the appellate authority is overburdened to pass orders. The tribunals have finished with all their pending cases. They hardly have any cases to be taken up. So they have come up with this amendment where they have allowed joint commissioners. They have made a new post as joint commissioner appeals. People who are below the rank of deputy commissioners, whatever orders that they pass, they can be adjudicated upon by the joint commissioner appeals now. So we are hoping that the pendency of litigation, the pendency of appeals will reduced very quickly, very fast. The only challenge is that you may not get much time to prepare for the appeals. So people who have appeals which are pending, you should get after it now, because you may start getting notices and you may hardly get any time. And even as an assessee, you have only one appeal. Your chartered accountant may have many. So you have to now follow up and get your papers ready so that whenever the appeal comes up, you are ready to make the compliance. Another interesting amendment that they have brought in the search proceedings. So earlier during the search proceedings, the only person that the tax authority could take help of, a professional, was a valuation officer. They've increased the scope dramatically. They say that currently the way technology has improved, assessing officer is not equipped to deal with the technology. You know, you talk about electronic items, you talk about cloud based saving of data and various other technology that people are using. Uh, During the search, the income tax officer finds it very difficult to unravel the mystery created by the assessee. So they have now allowed the assessing officer to take assistance from all kind of people. And interestingly, in the help that they can take, they have also included locksmith and carpenter. So people who have hiding places created, they can get these people and open everything and see everything. So apart from technical experts, people who are very good in technology, people who are very good in valuations of different kind of assets, even carpenters and locksmiths can now be taken help of during the course of search. Clarification regarding advanced tax while filing updated returns. So last year, there was a big announcement that we are going to allow, the finance ministry had announced that the income tax department is going to allow everyone to file updated returns, even if it is beyond the uh, revised return due date. Then when we read the provisions, it's said that if you are giving an updated return, first thing, it should have additional tax payable, only then can you update the return. Second thing, if you are updating it within 1 year, you have to pay 25% penalty. If you are updating within 2 years, you have to pay 50% penalty. Now they've brought in one more amendment saying that if you had missed filing your returns and you're filing your return for the first time under the updated return scheme, then the 234B interest will be computed from day one without considering the advance taxes that you must have paid. So now you will have to pay 25% penalty, plus you will not get credit of advance taxes paid for computation of interest under section 234B. Another important aspect which all businessmen will have to take care of, preventing permanent deferral of taxes through undervaluation of inventory, is the reason for which this amendment has been brought in. What they are saying is, earlier reference could be made for valuation purposes of property. Now they are saying, the proposed amendment says that if in the financials, the assessing officer believes that the inventory valuation is not correct, then he can refer the inventory valuation to a cost accountant. The cost accountant will furnish the report of inventory in the prescribed form. Sorry, the cost accountant will furnish the report in the prescribed form, which means that as a businessman, you have to keep details of inventory. Now, what happens is when we do audits, generally a remark is passed that inventory is as certified by the management. The number of items in the inventory are too many, so we've done a test check and we have relied on the management representation as far as the valuation of inventory is concerned, is the general remark in all audit reports. Now the assessing officer can say, okay, you've made this remark. I don't believe that the valuation is proper. So I want a report to be furnished by the cost accountant. Now the cost accountant says, okay, you give me your inventory list on the basis of which inventory has been incorporated in your books. When you give the inventory list, you actually will also have to give your purchase register and sale register, because the inventory will be the last item which has come in. And later on that item must have been sold also at a particular rate. So to find out what is the cost of holding the inventory, meaning your purchase cost, your other duties, your transport cost, all this will have to be kept by a trader. So person who's dealing in too many items is going to find it really, really tough unless and until some system is incorporated from now on so that inventory can be captured properly. Otherwise, this is going to be a big, big trouble for many, many businessmen. Allowing TDS credit for income already disclosed in the return of past years. So this was also another problem that people were facing. Many people were filing returns on accrual basis and they were claiming TDS. But the person who was paying that income was deducting TDS on receipt basis. So whenever he was making the payment, he was doing the TDS, whereas the recipient has already offered the income on the basis of accrual and claimed the TDS. Since the person who was deducting tax is doing on payment basis, it is not appearing in my 26AS. Since it is not appearing in my 26AS, the assessing officer has not granted credit. Now what they have said is that as and when this TDS is reflected in the 26AS, within 2 years you file a rectification application and you will get the credit of TDS for the year in which you offered the income and made the TDS claim. So this is going to give relief to quite a few people. This 245D amendment is pertaining to settlement commission. They have extended some timeline for disposing of uh, certain rectifications, etc., which are filed before the settlement commission. People who have to furnish transfer pricing report at the time of assessment. So earlier, for furnishing the transfer pricing report before the transfer pricing officer, a 30-day time limit was given. Then again, this was causing a lot of trouble to the transfer pricing officers because they had limited time to give their order, which was to be incorporated in the assessment order. So this 30-day time limit has been reduced to 10-day. And they have said that in any case, you always have the transfer pricing report. So why should it take you 30 days to file the report? So 10 days is what is the time limit that they've given now. This was always their set off and withholding of refunds. So what used to happen is people who had refunds in some years and they had demands in the earlier years, or their returns were under scrutiny for the year in which refund was claimed, the assessing officer used to hold back the refund either under section 241A or under section 245, saying that your earlier demand is pending, so we will not issue you the refund. We will adjust it against that. Or he used to say that your return is under scrutiny, so we are withholding for that till the time the scrutiny is over. Now they have removed one of the sections and they've said as a process, the earlier demand will be adjusted first. Whatever refund remains should be issued or it can be withheld if the assessing officer says that the scrutiny process is on and he will issue it after that. But there is no, it is not that the assessing officer can decide whether he wants to adjust or he wants to withhold for scrutiny. He has to follow the system. First, he will have to adjust against demand and balance he'll have to withhold if scrutiny is going on. Penalty for furnishing inaccurate statement of financial transaction or reportable account. So what is this? This is all the banks or the registering authorities where, when you go and sell a property, you go for registration and then the registering authority files an annual information return, or wherever there are high value transactions that you're doing with the bank or with the mutual fund agencies, they make an annual information return and they file it with the department. Lot of this data, based on this data, many returns were picked up for scrutiny or for checking. And they found that the data which has been uploaded was wrong. Either they have mentioned wrong PAN, they have duplicated the transaction, and it was causing a lot of heartache to the assessee as well as a lot of time waste to the assessing officer. So now what they have said is for every mistake that is found, there is a penalty of 5,000 that they're going to levy on the person who's uploading the data. This is going to be another huge problem because the people who are uploading the data and filing these annual information returns are really not equipped to understand how to do this. But now they are going to be saddled with huge amount of penalties. So friends, this is as far as the direct tax provisions were concerned. Now, Nishant will be joining you, and he will be talking about the GST implications. But before we go there, we can look at the questions, if any, that have been shared. I'll just have a look at the chat box if there are any questions. And there are two people, I think, who have raised their hands. So there is Anand, Manoj. I'll just switch on their mic so that they can then ask their questions, and then we can see what kind of reply can be given. So Anand, first is you. I'm trying to unmute you.
So good evening.
Yes, Anand.
Thank you for your deliberation. We entire team is listening you. My query is with respect to payment to MSME. Mostly what happens, the companies are holding their checks. They issue the checks, but they hold with them as the checks validity is for 90 days. So they keep in their drawer, but while doing the audit say that we have paid to the paid to the supplier. However, he has not deposited into the bank. So whether the provision is saying whether payment has to done or the amount has to credit to the supplier.
So what happens, Anand, is they are not saying that the credit has to go to the client. They are saying that the payment has to be done, which means if the other party says that I've received the payment, but I have not deposited, then effectively payment has been done and there cannot be a disallowance under 43B.
Right, but as the validity of checks is for 90 days, most of the time they keep holding the checks with them.
I understand, Anand, but see, the MSME has to take a stand that I'm not going to agree with this. This has been brought in to protect the MSME, but they can take steps only till where it is possible. Now, if the MSME also says, yes, yes, I've received the check, but I have not deposited, unless the MSME says that I have not received the check only, they have kept it in their drawer, I have not received it only, then it cannot be treated as if the payment has been made.
Okay, and sir, another is there is some amendment with respect to standard deduction of salaried people that I think we have not covered in presentation. So just a small deliberation on that. If
So in fact, in the new regime, that standard deduction is there. We showed it in the first two slides itself. There is
okay,
a 50,000 rupees standard deduction, which is there in the new regime. In the
okay,
old regime, there is no change. There is no standard deduction.
thank you, sir.
What was there in the old regime has continued to be there. But in the new regime, there is a standard deduction which has been brought in, which is 50,000 rupees.
Okay, thank you, sir.
Then is Akshay Ranka, I think. If he still has any queries, we can go to Akshay. Akshay, are you able to talk? 1 second. Yes, Akshay. Uh, Akshay, are you able to? Otherwise, we'll move to the next. Manoj Joshi has some. Yes, Manoj, can you? I think I've unmuted you. I think we'll continue with Nishant now. We will take up the queries at the end again. I'll just till then work out why the I hope I'm able to unmute them for allowing them to ask the questions. Yes, Nishant, over to you.
Hello. Hello.
Yes.
Nilesh sir.
Yes.
Sir, I have two queries.
Yes.
Basically, there is an amendment in rental part. Means they are saying ki only interest or interest component can be claimed as 24, or we can capitalize to the fixed asset cost.
Correct.
So wherever we are having any interest component more than 2 lakhs, so what about the upper limit other than 2 lakhs amount?
So other than
Can we
2 lakhs
capitalize
amount, you will be able to capitalize. So what they are saying is that whatever is allowed as interest, that double deduction will not be allowed.
Okay. So we will transfer 50 lakhs to P&L or capital account, and rest will be capitalized to the fixed assets.
Correct.
And second question I have, sir, the 45(5)(a) amendment.
Yes.
So there is wherever there are area as well as monetary consideration for existing DAPA wherever there are. So what implication there is on those agreement?
I could not understand your question. You are saying that wherever there is an existing agreement, where there is a DAPA, and what is the TDS rate when you are receiving certain amount in money and certain amount in area?
Area. Right, sir.
The TDS is 10%.
So there you had said ki stamp duty valuation is to be the consideration value.
Hmm.
So can
So
you
what
explain on
happens
that?
is, there is certain area that you are getting at the end of the project,
Right.
and there is money that you're receiving from time to time.
Right.
The money that you're receiving from time to time, there will be a 10% TDS.
Okay.
And for the area that you're receiving, there is no TDS. At that point of time, you will be paying the entire tax on the completion of. Am I clear? Is your query resolved or? Hello?
Sir, thank you, sir.
Yeah, okay. Okay. Okay, friends, over to Nishant.
Hi everyone. We'll quickly jump to the indirect tax or the GST amendments. There are hardly anything because GST is known for its updation on a daily basis. So probably a budget is known only for the amendments which cannot be done otherwise, or since every amendment in GST has to go through the GST council meetings. So first is the decriminalization of offenses. This was always discussed, and I mean the approval has already been made in 48th GST Council meeting, where prosecutions have been, prosecutions for the limits for prosecution has been increased from 1 crore to 2 crores, except for bogus invoicing. The threshold for of prosecution remains 1 crore for bogus invoicing, and for compounding, it has been reduced to 25% from 50% and from 150% to 100% of the tax amount. E-commerce and small micro enterprises, the composition dealers were earlier not allowed to sell through e-commerce operators, as discussed in the 48 GST Council. Now composition dealers will be allowed. Necessary amendments have been made in section 10(2)(a), where the e-commerce operators now can sell through the e-commerce. The composition dealers can sell now through e-commerce operators. Please note that services, the exempt, even if you're unregistered, you can provide services through e-commerce operators, which has already been notified through notification 65/2017. The important part is services otherwise. Say for example, you are less than 20 lakhs. You are a dealer who is less than 20 lakhs dealing in taxable goods. You are still not allowed to sell through e-commerce operator. Only composition dealers and dealers who deal in exempted products will be allowed to sell through e-commerce operators. Yeah. Now, since e-commerce operators are the new way to sell goods, the liability on e-commerce operators have now been increased, where the minimum penalty is 10,000 for every failure. The failure to allow sale by an unregistered taxpayer, unless such person is allowed to do so. Allow an interstate supply by a person who is not eligible to make interstate supply, and furnishing details of supplies made through it by a taxpayer exempted from registration. So such penalties would be applicable. It's important to note that such things would again have an impact, considering the authorities being allowed to suspend registrations on account of various reasons, including non-filing of returns, or classifications as non-genuine taxpayers, and other reasons for which registration can be cancelled, for which e-commerce operators could have an issue, since they are done from a previous date rather than an updated date. Yes, tax reversals, interesting one. Section 16 has been amended. I'm still guessing what happened. Actually, they brought a rule 37 since 26 December 2022, but they couldn't make an amendment in section 16(2), where if you fail to pay a vendor within 180 days from the date of invoice, the earlier provisions stated that the tax amount was supposed to be added to his output tax liability. So an output tax liability, if it is added, the interest starts from the date of invoice itself, and the interest under section 51 was supposed to be done, but the problem started with that the provisions never stated under which provisions the interest shall apply. So and if the credit was never utilized, the argument whether such reversal or never, since the credit was never utilized, whether interest shall applicable was having an issue when it came to GST audits and other representations made before the authorities. So to avoid that part, the proposed change is made where they said that the amount, instead of adding it to output tax liability, would now be stated as to be reversed, or basically to be paid. So the same can be paid through DRC 03 by reversing credit or paying in cash. The same can be done through GSTR 3B also. But the important part to be noted is basically whether interest under section 50. The provision says that interest as payable under section 50. Please note section 50 has not been amended to include what is being proposed to say it at any amount being payable under section 16(2). So we always conclude that the interest payable under this provision would be interest under section 16(2) and not under section 50. This would also give a proposition to say that since the amendment is done today, from the date of enactment of the bill, so whether any interest would be applicable prior to the insertion of the amendment. A position can be taken to pay no interest on such tax reversals, or basically on output tax liability. since the interest was not notified. Rule 37.2 also proposes to have an interest as per section 50, but the problem starts with that section 50 never refers to such things. And as we all understand, that interest is actually a substantial, or basically what we call as a substantial levy, and cannot be done through rules, but has to be enacted through the act. That is where you can take such positions with respect to payment of interest prior to such amendment with respect to non-payment of vendors to within 180 days from the date of invoice. Yeah, retrospective amendment exemption is made on supply of warehouse goods. Interesting one, but bad news to the actual warehousing people. What has happened is there has been an exemption provided to warehoused goods, where this amendment was made. This was the amendment was already made from 1st February 19. Now the amendment is made from 1st July 17 to give exemptions. The problem starts with, since they are exempted, since they are neither supplies, because it has been amendment in Schedule 3. The 17.3, Section 73 was also amended to include that such supplies would also be included in the value of exempt supply for purpose of reversal. So any supplies made from warehouse goods from the warehouse would be now liable for reversal of credit, including, the warehouse rent, the transportation charges, other charges would be impacted. This was actually done for denial of refund, or the original idea was to deny refund to the duty-free shops who were claiming exemption of refund for sale of inbound passengers who were coming to India and were buying from the duty-free shops. However, this rippled back, where the many courts have given decisions in favor of the duty-free shops, where they were treated as exports since they are considered outside India. But with this reversal of credit, now they would not be entitled for the ITC, and this would impact as such as if it was as if the refund was never be entitled for. Interesting to note that taxpayers who have collected and paid GST on such supplies would not be eligible for refund. ITC on CSR expenditure, yes, the most critical one, where CSR being a mandate under the law, and probably the intention of the authorities is to have that as a profit sharing apparatus with the companies, rather than an expenditure to be allowed as under the Income Tax Act or under the GST Act. That is where now the specific reversal or the specific denial of credit with respect to any expenditure incurred towards CSR is being considered. Please note, there have been judgments, advance rulings in favor, like you have the Dwarika Sugar, the Bambino Plasta, but there were also few negative decisions, including the Adama and the Polycab wires. But this could create an issue in previous periods. The future period is very clear, where you have a specific denial of the credit. The DGTS, the post budget session, DGTS in a session clearly specified that 17.5A is inserted as a specific provision, or as a clarificatory position to deny the credit, where the earlier credit was supposed to be denied under gifts. I don't know whether such provision, whether that stands correct, but the intention of the government is to deny credit prior to the amendment and post amendment also. So to ensure we can always we may have to fight prior to the periods prior to the amendment. Please note that, and that has to be considered. Yes, the time limits. The time limits to file GST returns is to only ensure that the compliance is made for specific period. I don't see any other reason, since considering no credits have been passed on in 2B or otherwise. So taxpayers can now file returns up to 3 years from the due date. the returns are GSTR 1, 3B, GSTR 9, and GSTR 8. Such time limit for 3 years can also be extended on recommendation of GST Council with conditions. Yes, OIDR, yeah. OIDR, the definition always included those services where human intervention may not be minimal. These were always to be, these were excluded prior to the amendment. Now the amendment intends that the human intervention may not be minimal, or where the services are always automated. Irrespective of such things, all the services will be considered as OIDR. And I mean, the intention seems to be to for the pre-recorded coaching or training modules, the examinations, evaluations, where the human intervention was always considered. I mean, the scope with this amendment would almost include everything which is available on the internet for a price. So I don't know how the authorities would do this, but it is important to note that every person who is selling on the internet and a non-registered person buying in India would have to be registered in India. That's how the provision look like, and that is how things would be. The tracking, as I said, would be an issue considering the changes made, and tracking of who's buying what from India. Place of supply in case of courier out of India. This was an issue where section 12(8) of the IGST Act used to say that it would be an interstate supply, and the location of the recipient, I mean the location of the goods, was considered to be the place where IGST was applied, where the credit was an issue. However, with the circular provided recently post the GST Council meeting, they said that a credit would be allowed, and now this proviso is deleted. So with this deletion of the proviso, now the location of the recipient, that is the Indian supplier, would now be the place where the services are provided, and now credit can be duly claimed. In proposed amendments in customs, there are change in BCD rates for various sectors: electronic appliances, automobiles, IT electronics, gems, jewelry, petrochemicals, in minerals and agriculture goods and byproducts. There have been extensions to exemptions. I mean, out of the 146, if I remember correctly, just a moment. Yeah, out of the 196 exemptions, 146 exemptions are being extended for a period of to 1 year, that is March 24. And rather, for the balance 50 exemptions, there have been few exemptions which are extended to 5 year, 3 year, 2 year, 1 year, and few exemptions have also been withdrawn. There have been proceedings. I mean, the interesting one is the Settlement Commission proceedings, where they have said that the proceedings before Settlement Commission has to be completed within 9 months, and an extension of 3 months can be allowed. However, if the order is not passed within the due period, the order shall be, the order shall abate, and the proceedings will now start as if there was no application made before Settlement Commission. I don't know how to describe this position where there has been no issue from the assessee to apply and to represent. However, due to lack of manpower or any other reason, before the Settlement Commission could not provide the orders, the assessee has to fail. Assessee has to face the issue, because the whole purpose of applying before Settlement Commission now stands as if it was never applied. There have been certain exclusions from the conditional exemptions. You have default expiry of 2 years. If you remember, that was passed. So now there have been some extensions given to, yes, there have been exclusions from the conditional exemptions. It is like a multilateral or a bilateral trade agreement. You have schemes under FTP. You have privileges of constitutional authorities. You have re-imports, temporary baggage, temporary imports, and many other things. It's important that these conditions, these are exclusions. So it's a good thing, considering the two-year time limit is a very short limit for the schemes under FTP. That's it from my side for FTP. Happy to take questions. Happy to note that there are no queries with respect to GST.
So friends, it was our privilege, and it's been nice to host this session for all of you all. It has always been our endeavor to reach out to our colleagues, friends, and clients and share whatever that we can as far as these provisions are concerned. Our office would be happy to assist you if you have any questions or queries with regard to the budget. And we would be happy to receive your queries on email, and we would try and resolve them. It goes without saying that whatever that we could present today was not possible without the help of our team. Our respective teams, the GST team and the DT team, have put in a lot of effort to bring all this together and helped us, go through everything, because in 2 days to go through everything, prepare some notes and get into some deep aspects of the provisions is not that simple. Without the help of our team, it could not have been possible. We propose to have this kind of a budget session each year regularly after 2 days of the budget announcement. So you could keep that in mind whenever next time the budget is. Definitely we'll try and complete, we'll have a session within 2 days time. And we would also want to host such small sessions on various amendments or changes that come from time to time, or interesting issues or decisions that come from time to time. Happy to inform that on today's session, we have people, our colleagues from Indore. Ankur is there from Aurangabad. Anand is there from Bagalkot. We have Venugopal. We have our associate offices in all these places, and they are also part of the session today. I'm hoping that few of their clients are also there, just to let them know that as a group, we are all there to support whatever help that you would want. Thank you for being with us today, and hope to see you all soon. Thank you.
Thank you. With these words, we close the session.
We'll close the session. Yes.
Thank you.